Welcome to Cotality's Housing Market Update for August 2026, brought to you by First National Real Estate. Australia's housing market downturn accelerated through July, with the latest Cotality Home Value Index showing a 0.7% decline in national dwelling values. That's the largest monthly fall since December 2022, and a clear sign that housing conditions have weakened materially over recent months. Importantly, the downturn is no longer confined to Sydney and Melbourne. Sydney home values fell by 1.4% through July. Melbourne values were down 1.2%. These markets have been leading the decline for some time, but the latest data shows the softer conditions have now spread into the mid-sized capitals as well. Brisbane housing values fell by 0.6% over the month. Adelaide was down 0.2%, and historical revisions show both cities have now recorded 2 consecutive months of decline. Perth was the only major capital city to remain in positive territory, posting a modest 0.1% rise in July, although revisions to earlier data show conditions have weakened much more rapidly than initially thought. What we're seeing is a broad-based loss of momentum across the housing market. Affordability pressures, serviceability constraints, 3 cash rate increases this year, higher living costs, weak consumer sentiment, and uncertainty around policy changes announced in the federal budget have all combined to weigh on housing demand. The weakness remains most apparent across higher-priced housing markets and premium housing stock. Nationally, the upper quartile of home values have fallen by more than 3% over the past 3 months, while lower-priced housing has remained relatively resilient. A changing market is also becoming evident through listings activity. While total advertised supply is tracking higher across the capital cities, the flow of new listings has started to deteriorate in recent weeks, particularly in Sydney. Many prospective sellers appear reluctant to list into a weaker market environment and are choosing to wait for conditions to improve. Even so, advertised stock levels remain elevated because demand has weakened faster than supply. That imbalance is also showing up in selling metrics. Capital city clearance rates have remained below 50% since late May, highlighting an ongoing gap between buyer and seller expectations. Private treaty sales are taking longer and involving larger discounts as buyers gain more leverage in the negotiations. Regional markets have generally outperformed the capital since late 2025, but they're no longer immune to the slowdown. The combined regionals index fell by 0.2% in July, marking the first monthly decline since January 2023. Regional New South Wales recorded the weakest result, while regional Victoria and regional Queensland also moved lower. Regional South Australia and regional Western Australia remain the standout performers, continuing to post solid growth through the month. Turning to the rental market, conditions remain tight, although rental growth is gradually easing from the recent peak seen earlier this year. National rents rose by 0.4% in seasonally adjusted terms during July, while annual rental growth held steady at 5.9% for a third consecutive month. Over the past year, that equates to roughly $40 being added to the median rent. The main reason rents continue to rise is the ongoing shortage of available rental stock. Although the national vacancy rate edged slightly higher to reach 1.7%, it remains well below the long-term average and continues to place upwards pressure on rental values. At the same time, rental affordability has become increasingly stretched. Median rents are now more than $200 a week higher than they were 5 years ago, and households are dedicating a record share of their income towards housing costs. One consequence of falling home values and rising rents is that rental yields are improving. Gross rental yields across the combined capitals have lifted to 3.56%, their highest level since 2019. However, higher yields alone are unlikely to be enough to drive a meaningful lift in investor demand, particularly given the increase in borrowing costs and the changes to negative gearing announced in the federal budget. Adelaide home values dipped by 0.2% in July following a 0.3% decline in June. This weaker trend has been driven by the house market, where values were down by 0.2%, while unit values were unchanged in July. Greater competition for more affordable properties meant that there was no decline in lower quartile values, while the mid-market and the upper quartile properties were weaker. The available supply of properties in Adelaide has shifted rapidly in recent months, now sitting 2.2% above the 5-year average, compared with 38% below average at the start of the year. Overall, the July data confirms that Australia's housing downturn has become broader and more entrenched. What began as a correction centered in Sydney and Melbourne is now spread across much of the country, with previously resilient markets, such as Brisbane, Perth, and Adelaide, also recording declines. In fact, more than 3/4 of capital city suburbs recorded a decline in home values over the past 3 months. The common thread is weaker demand. Affordability constraints, higher interest rates, cost of living pressures, weaker sentiment, and changing investor dynamics have all been working in the same direction. And for now, there doesn't appear to be much immediate relief on the horizon. From August 2nd, the end of the temporary fuel excise discount is likely to add another layer of pressure to household budgets. The good news is that the interest rate outlook has become a little bit more balanced. Inflation data has softened, market expectations are increasingly centered on interest rates having peaked, and the likelihood of further rate rises has diminished. However, it's still too early to rule out additional tightening altogether, with the Reserve Bank making it clear that inflation and labor market conditions remain the key variables to watch. Consumer confidence has improved a little from the lows, but sentiment remains deeply pessimistic by historical standards. That's important because confidence plays a critical role in housing activity. Buying a home is often the largest financial decision households will make, and it's difficult to see a meaningful lift in housing demand while households remain so cautious about the economic outlook. For buyers who remain active in the market, conditions have become more favorable. There's more stock to choose from, competition has eased, selling times have lengthened, and negotiating power has shifted away from vendors for the first time in several years. At the same time, we're starting to see the market adjust on the supply side as well. New listings are slowing as potential sellers choose to sit on the sidelines rather than bring their property to the market in weaker conditions. Combined with ongoing constraints on new housing supply, that adjustment could help to place a floor under values and limit the extent of the downturn. Our expectation remains that housing values are likely to move lower through the coming months. However, the factors that would normally underpin a sharp correction simply aren't evident. Unemployment remains low, population growth continues supporting underlying housing demand, and both construction challenges and vendor caution are limiting the availability of supply for housing. The areas most exposed to further weakness are likely to be the higher value markets, locations, and those with a stronger investor presence. Looking ahead, the key indicators I'll be watching are underlying inflation, labor market conditions, and how those factors influence Reserve Bank policy. We'll also be closely monitoring investor behavior under the new policy settings, along with whether elevated stock levels begin to moderate as new listings pull back and whether supply remains high as buyer activity slows further. For now, the balance of risks remains skewed towards softer housing conditions, but the evidence still points to a gradual downturn rather than a sharp correction. Thanks for tuning in, and remember you can access all our housing market updates at the Insights pages of the Cotality website.